This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Coveil. Not filtered, raw, honest. That's my passion. So today on the show, I have MICHAEL. Mike is an investment manager out of Tennessee. He is a trend-following investment manager. And Mike is he uses ETFs in his trend-following trading. So he's covering all the markets that a lot of the trend-following traders that I've long discussed are right in the middle of. But he's using ETFs as his vehicle, which I think is a unique proposition. And we'll learn some more today about Mike's performance, his style. But I think it's going to be a really interesting conversation because I tell you what, when you take a look at Mike's blog, you're just going to see it's the stuff that I love to put in my books. He's got on his blog and taking it in detailed ways that I've not taken it. So really interesting stuff. Mike, I want to welcome you to the show today, and I think we're going to have a good time.
How you doing, Mike?
I'm doing well. So now just a little background too, and maybe you can expand on this some. I do know I think the first time we exchanged emails, 05, 06, it's been a long time. We've never met. I know some of your background. I know you're a former Marine, but just maybe you could take a little time and just kind of outline MICHAEL from youth to today. How did we get to, how'd you get to be here today?
Well, I guess when I got out of high school, I joined the Marine Corps, so I went a little different than some, I guess. But went into the Marine Corps, got out, actually got injured in the Marines, and got out and became a police officer here in Tennessee for a few years while I went to college. So I worked full time as an officer while I went through college, and that's when I became a workaholic. And so over time, I became interested in finance and investing and trading and things like that. And over the years, got to know a lot of people who are, some of them are quite famous in trading, investment management, and over the last, several years, I did it professionally through various firms, and then in 2004 started Shell Capital Management, which is a registered investment advisor. A little different than a lot of the trend following systems that you normally speak of, because rather than a CTA, we're an RIA, and so we're trading in exchange listed or exchange traded funds, as you mentioned, and mainly because we're mainly managing accounts for profit sharing accounts and IRA accounts and individual accounts, and these are mostly a smaller group of people that we know who know what I do and how I do it, and they tend to be physicians and engineers and business owners and things like that, and so not necessarily, we don't trade any futures or derivatives, and we don't use options or margin. Not that there's anything wrong with those things. Certainly those types of securities have their way too, and they're normally done in a hedge fund, whereas what we're doing is we're doing it in a separate account program. So our investors have accounts that are titled in their own name, and we're managing the accounts sort of as a model portfolio.
Well, let me take a step back, because I'm going to definitely reach forward to a lot of the things you're doing today. But I think philosophically, I think you have a lot to offer to listeners. And I've pulled a bunch of things from your blog that I think are really interesting. And I'm going to let you. I'm going to read this. It's kind of a brief passage. I'm going to let you expound upon it, because I know it's clearly dear to you. And the quote is this, quote, "Projection makes perception. The world you see is what you gave it, nothing more than that. But though it is no more than that, it is not less. Therefore, to you, it is important. It is the witness to your state of mind, the outside picture of an inward condition. As a man thinketh, so does he perceive. Therefore, seek not to change the world, but choose to change your mind about the world. Perception is a result and not a cause, end quote. And I was wondering if you could kind of expand upon that and maybe talk to why that's so important to you.
Well, I think it's as you know, that would be a common that's a paragraph from A Course in Miracles. Course in Miracles is really a manifesto for your inner voice, I guess, and some people will say that it's about sort of, I guess, forgiveness or something like that. I think that you'll hear that a lot among a lot of really good traders or investment managers. When I say trading only because trading means buying and selling things, whereas investors may buy and not ever sell anything. So you'll hear that a lot, and the reason is that in order to create good results in the market, you have to be very clear in your own mind. And I think that what that statement really says is that we create the world we live in our own world, and we all perceive, you can talk to 10 people and everybody perceives the outside world differently. And that's because we get to decide what our world looks like, and we get to create our own results. I think that's a major difference in investment management. And what you'll find within a lot of trend followers is, although there's an infinite number of ways we can define trends, there are certain things that we find that are common between all of us, and that is how we do things and how we deal with the investor psychology side. And I think that what I had used that quote to mention was that, we don't watch the news and pay attention to a lot of the news that a lot other people may pay attention to, but instead, we're focusing on quantitative directional price trends. And so, I hear, but I live in the world too. So, I'm around other people, and I hear people concerned about what's going on in Greece and the government debt being downgraded. I hear those things, and I think that what happens is a lot of times people get caught up in those things, and they can create this world in their mind based on that information that they hear, and that can be very different from a person who has maybe, decided to see things a little differently than they do.
Well, and I think that you're being subtle and humble about it, but it's somewhat a foundational view for how you trade, because what you're saying is instead of necessarily projecting your opinion onto something, you're saying, hold on, I don't need to have an opinion about that. I have my system, I have my rules, I can respond. But you're not trying to project a view. Maybe talk to that a little bit more. That's exactly right. And that's why, there's so many things that one little paragraph, and I'm sure you've heard that paragraph quoted before among other people that we both know. I think that you're not really trying to, most people, I always say that most people are sitting around, most investment managers or investors or traders, whatever you want to call it, are sitting around trying to figure out what to do next. And they're trying to sit around and figure out what they think is going to happen next. And that's kind of a joke with me and among the people that I communicate with regularly, is that, most people are trying to figure out what's going to happen next, and they try to predict things. And, I'll tell you, the funny thing is a lot of passive investors who asset allocate and are more passive, they correctly have a lot of comments that they make negative about active management. And most of the time when they're talking about active management, it's primarily relative return managers. So those would be like most of your mutual funds, they're trying to beat some index. And so mutual fund managers, they believe they can pick stocks, and they believe their picking ability, the stock pick is what causes creates their outcome. And so they believe they have a better stock picking system. Of course, many studies show
ago that most of them don't really do very well at it. And that's where, they have an opinion about the stock, and they do all this research. Now think about this: you've got some company you like, and you do a whole lot of research on it, and you think it's a great stock. You buy it and you hold it. And I think the trouble is that the more research they do, the more confident they become in that position that they've taken. And what really where they stray from the rest of us, those of us who are doing a more tactical trend following type system, which is by the way the main emphasis of what I think is common between all of us, as you would read in Market Wizards or all of your books, is active risk management. And the thing is, when people think that they can select an investment and determine in advance that it'll do well, that they're assuming that they know the future. And the more you believe that, the more you think you're right about what you've bought or what you've invested in, then the less likely you are to predefine or predetermine your risk. So if you buy it at 50, for example, you're probably pretty unlikely to say, well, you know what, if it goes down to 45, I'm going to sell it. Now, some people say, well, why would you want to do that? Well, because it may go to 30 or 20 or 10 or 0, you see. And so I think the big key about what we do, or what I do, and what other people similar to me do, not all of them, obviously, but some of them, is predefining risk and actively directing and controlling risk, and specifying how much that is in advance and through the course of the trade, from the time we enter all the way through the end. And other people, though, you see, they're as you say from the quote, they are stating their opinion about something. They get caught up in that opinion, and the more public they are about that opinion, the more they've got to stick to it, or they feel they got to stick to it, and the more strongly they've done the research and more confident they are in their opinion about whatever they've bought, then they're going to more likely stick to it. And I think what happens then is you turn around and you've got this position. It's been a great company, a great stock. You're up 500%, and now all of a sudden it's going down, and it doesn't take 500% to wipe out 500%. So 100% gain takes 50% to wipe it out and have no more gain left. And so they hold on to it. You see, the more confident they are, if you believe you know in advance the outcome of that particular trade, then you're very unlikely to actually try to attempt to control the risk of it by predefining what point you'll get out if you're wrong. And the more confident you are in your research and your beliefs and your projection about the world or the outcome of that position, the less likely you are to manage the risk of it.
But see, Mike, you say this, and I've seen these great lines from you. You talk about it. We're taught that it's good to know, bad if you don't know, and just people hate uncertainty, and it's the human nature to try and figure it all out. And you're basically saying, hey, Coveil, don't try and figure it out.
Yeah, and I mean, hey, you mentioned the word there, uncertainty. It's one of my favorite words. I mean, the funny thing about it is we're always uncertain. We're uncertain about everything. We got up this morning, drove to my office, had plans, the things I was going to do today. Pulled up at my office, and this gigantic oak tree, it's 8 foot around, has fallen into the parking lot. Turned the power off, and now I'm having this phone call from luckily my other office, which is on my boat, and so. We have several other places to go, but we're doing that here. I mean, we would have never known that in advance that was going to happen. I mean, everything that we do in life is uncertain, and I think that what you have to do is you have to embrace uncertainty. And uncertainty, listen, uncertainty are the things about life that makes it fun. Who wants to watch a movie when somebody tells you in advance what's going to happen in the ending? Speaking of movie, that very quote that I mentioned that you quoted, come off of a blog post I did on our blog, and it's about the movie Act of Valor. Former Marine myself, that movie means a lot to me, but hey, it means a lot to most Americans. If you watch it, you'll see why. And at the end, it's got a very, interesting ending. I'm not going to tell you how it ends, but I'll just tell you that. But if I did tell you how it ended, you see, you would sit there and watch it, and it would take away from watching the movie. And that's the way life is that, gosh, if we go through life and if we always knew what was going to happen tomorrow, it'd be pretty boring. And if you really think about it, I did a lot of research years ago on happiness and what really makes people happy. and it's experiences that we have in life. And I can assure you that if we don't have experiences that are a little bit unique from time to time, we get bored. We don't enjoy it anymore.
Well, I was thinking it completely unrelated, but I was thinking about certainty, and I was like, well, no matter what I do, if I go into, and I'm not picking on Walmart, but if I go into Walmart, I know exactly what's going to happen by the time I exit. There will be no new experience that's going to happen in Walmart. And I'm afraid there's a certain amount of that as you speak to this desire to have, like a lot of people want certainty. It's not necessarily a great thing to try and have it. And I think what you're speaking to is more the embracing of uncertainty and saying, hey, we don't know what's going to happen. And trying to know is very, very hard, if not impossible. And if you don't spend all your time trying to know and you put a system in place, you can actually find some profit from a place that perhaps you did not think you could.
And that's exactly right. And I tell you, and I like the path of where this is going, because, in embracing uncertainty, over the years, I've been running the Asymmetry R15 program now for 7 years in real time with real accounts. And prior to that, I did a lot of research starting around 2001. That prior to 2001, by the way, you asked about my background. Prior to 2001, I actually started out being a big William O'Neill fan. I started, fortunately, How to Make Money in Stocks was the first book I ever read about the market, and that was in probably 1991. I happened to read it. It really, a friend of mine and I both read it, and it really made sense. I was a really young guy, but I had a bad experience with buying a stock right prior to that and lost money in it. And what I was reading in that book was the opposite of what I was being told when I bought this stock that I'd bought. I don't want to get into all that, but this book was talking about, relative strength and momentum and buying, price trends that are going up and all these things. And from there, I expanded into, now Bill O'Neill's not actually a technician. He don't consider himself a technical analyst, I don't think. He's more of a chartist. But I started studying more technical analysis and getting into a lot of the detail from various types of technical analysis, and became really pretty good at it. And pretty well known for certain forms of about it. I was considered a craftsman among certain forms of technical analysis. And then I guess about 10 years ago, a friend of mine actually said, Mike, I know you've done pretty well with what you're doing here, the charts and everything and technical analysis, and it's focused on supply and demand. But how do you know that you've not just been lucky? And that's when I was introduced to quantitative analysis, which is where you rather than just looking at, in other words, rather than somebody saying, we buy this particular, when this signal happens, we do this, and when that signal happens, we do that. Most people are doing those things. Talking about uncertainty, most people do those things without really knowing the probability or the expectation of the outcome of those particular signals, and that's the downside of a lot of forms of technical analysis, that it's not been quantified, so they don't actually even know how often it's right and how much it wins when it's right, and how often it's wrong and how much it wins when it's wrong, which is mathematical expectation, and that is the essence of portfolio management, and so we started quantifying those things, started testing various indicators and systems, and here 10 years later, I've probably tested maybe millions. I know it's been many thousands, but maybe millions. So I've got this frame of reference in my mind of all this work we've done over the past decade or so, of all these different things we've tested, and the systems that I developed a decade ago that I've been running in real time now for 7 or 8 years. And by the way, you test the systems and you come up with all the various, things that you believe are most likely to work. And then you have to walk those systems forward, meaning that you develop a system and then you watch it in real time for a while. And gosh, I would think it'll be a few years before you actually put people's money into it. And that's how I did it. We tested things, we used it, with my money or simulated it for years, and we put real money into it, and it went from there. And that's when you quantify it. And to give you, let me say what quantification really means is that, that's when we can draw, keep in mind, we're dealing with uncertainty. We don't know the outcome in advance. Okay. We don't know the outcome. I can tell you that our individual trades are as random as a coin flip. And ironically, efficient markets theorists say, oh, it's a coin flip. Well, yeah, you're right. The market's not a coin flip. The market's trend, okay? Markets do trend. But our individual trades are a coin flip, meaning that we don't know in advance. It's uncertain. We don't know the outcome in advance. If you do, you only need to know that one time. If you believe that some institution out there knows in advance what the market's going to do or some stock's going to do, they'd only need to know that one time. They could lever that up 50-1 and boom, it'd be one big trade and it'd be all it was, and they'd go buy a couple, baseball teams, football teams, and a big recliner, and that's all they'd ever have to do again. Now, when you quantify things, here's the real key to it, is that what you're saying is that we can determine the probability and the expected outcome, the expected mathematical expectation of things if we have data, okay? So we can determine probability by having historical data. And if you have tested a system that buys and sells in sizes, and you've done that over a period of time, and you've done it over a series of price data. Now just visualize, let's just use for a simple example the last 20 or 30 years of the stock market. If you've tested a system that systematically and quantitatively with discipline and repeats the same buy and sell signal and determines how much, across that period of time, then if that same data is present in the future, then it is pretty likely that system is going to create the very same results. Now, and we're talking about perfection here. In other words, in a perfect world, you could back test and come up with some system, and then in a perfect world, the forward-looking information data that you'd get, the price trends, would be just the same, you see. Now, and if that happened, you'd have the same performance history. Now, the problem is it doesn't work that way. The problem is that the data does change over time. There's there's lots of different market conditions. So if you don't test over enough market conditions, then you don't have enough data in your system, in your testing, the scientific part, to apply going forward. Now, if you do have enough data, and say you've created, like in my case, we created equity curves, meaning price trends, that didn't even exist. We took price trends and chopped them into pieces and threw them together so that we would see all kinds of how the systems would work in various conditions, you see. And if you have tested in a scientific manner a system that buys, sells, and sizes, and that data does look similar in the future, then with high probability, the probability first of all, because you know what percentage of times it's profitable and how much it wins when it wins, what percentage of time it loses, and how much it loses when it loses. And you put that together and you've got the complete expectation. Now, by the way, Mike, as you know, most people focus on just one part of that equation I just gave, and that is the probability. They want that 90% win ratio. Yeah. You see, they don't focus on the payoff, and you see all these silly systems.
Well, that's the sexy part. That's the sexy part, Mike.
That's right. Why? Because we know why. Because it's people. People want to be right. I mean, hey, we know that we've been taught since first grade that if you want the A, you better score 95 on all the tests. You want to go to the championship, you better win all the games. I mean, that's just how we're taught and we're raised that way. Now let me say this. I've noticed in my career of doing this, both for myself and for other people, is that, and I know a lot of other investment managers of all different types, and I have noticed that there's a correlation, and I know that you know this because you've alluded to this, as have a lot of other great, really good trend followers, is that it seems like, and I'm not saying there's anything wrong with, getting a, high level degree and having a high GPA or anything, but I can tell you this, I have noticed that the people like myself, I wasn't really brought up to be so concerned about getting the A. And I personally, I've always created my own results. Nobody ever really told me what I needed to do, to tell you the truth. So, I just kind of charted my own course my whole life. And I'm a very clear definition of independent thinker, I can tell you that. And I'm not, my ego has never been tied. My self-worth has never been tied to how often I'm right or wrong about things. For me, it's always been about the magnitude.
But Mike, can I interject though? As you say that your ego has never been tied, and you're speaking of that, can you take that back to a younger age? Was there something? How did you develop? where did that trigger happen? Most people don't think like that. This whole, and most people want to be part of a team. They want to be part of a group. They want to work for the man forever. How did you develop this independent thinking?
Well, I tell you, the funny thing is, Mike, to tell you the truth, I like, we would like to find more of the people that want to work for the man. Thing is, I like to find those people that want to, that really don't want to be me, but they want to, come and maybe help me. But,
well, you don't want you working for you. That'd be a problem.
Yeah, that's exactly right. I think, in fact, I think Richard Dennis made a comment about that whenever they interviewed the traders in the early days. But I think, I think that, for me, I think that, I'm probably, as a lot of us are. You look at a lot of, whether you can talk about, even get outside the industry and talk about Michael Dell and Steve Jobs and Bill Gates and Mark Zuckerberg and, the Facebook. Look, all these people are independent thinkers. They all just kind of went their own way. And, listen, we would never create anything. Nobody would ever create anything really great if you didn't have people out there who don't just go by the book, because, these things that these people have developed, they had to think outside the box in order to get there. And I'm not real sure of what causes that, but I can tell you this, and I believe for myself that I think I just didn't quite have it's probably funny. On the one hand, as I told you, I graduated from college a little differently than others. I was in the Marines and police officer and worked full time because I wanted to get a degree in accounting and business administration. I did it only because I wanted to, but I wasn't told that I had to, you see. So I think that I never was pressed like other people were, that, hey, you come home every day and you got to have an A, or, you got to go out there and win every game. I think that it's really important that if you want to be, say, a surgeon, you're going to need to know, you're going to go through 8 years of medical school, and you're going to need to be really good at studying and doing all those things and following what you're told, the procedures, because that is it's a physical scientific process. The scientific process I'm dealing is far more in human nature and investor behavior. People control the market, so there's a lot of, you have to accept uncertainty, and uncertainty means that you don't know the outcome. So you have to really truly accept that you don't know the outcome of anything that you're doing, but you can take it's like flipping a coin 1,000 times. You know what? If we flip a coin 10 times and it's a fair coin and 50% chance of landing on one side versus the other, if we flip it 10 times, it's liable to be 7 and 3, right? If we do it 1,000 times, though, it's going to be 50-50. It's going to be 500 and 500, and that's just that. You can create what trend following trading systems of the various kind there are. What they ultimately are doing is they are creating a higher average profit than average loss, and we call our program Asymmetry, which we trademarked. And what we mean by that is that overall, through the full course of a market cycle, say 5 years, we intended on having a system that would create greater average profits than average losses, and that means a greater total return than a drawdown. So, that's that is all about, amazingly to a lot of people, I think, is that is all about completely embracing uncertainty and doing things that have truly, believe me when I say that I truly know that in advance that I don't know the outcome in advance. And there are times when the markets, various markets, we trade stocks, commodities, bonds, and currencies through exchange traded securities. There are times when those markets can get in a certain condition where they have overreacted or underreaction. By the way, underreaction of investors is what causes trends. We all may get the same information at the same time, but we perceive it differently and we act on it differently and at different times. Overreaction, though, is the other side of the coin, and that is when a market moves to the point where investors are very euphoric and they've become complacent. I tell you, the stock market.
Would that be? Hold on. I see your great line here on your website, the animal spirits line, the spontaneous urge to action rather than inaction.
Yeah, and that actually, the funny thing is, I started to post something much detailed piece about the stock market. For example, right now, I don't like to get into a lot of details on these things, but it's just an example that sometimes markets can get to the point to where they signal counter trend moves, and that don't mean that it's a sure thing, but the probability becomes that there's things like investor sentiment. When investor sentiment gets really bullish and most people are pretty excited, that occurs after prices have already gone up for a while, you see. And like right now, if you look at a stock market index, you'll see that the price has gone up for 15-20% over the last several months, and you'll notice the volatility starts to go down. That's a sign of complacency. And then it's those times whenever you do get any little movement to in the reverse direction, all of a sudden they get shocked and scared, and then you find out what's going to happen with the trend. But those kind of things do occur from time to time where we primarily want to get on the side of the trend, or the prevailing trend, but that's not to say that there's not some level of human element where we're sitting there saying, okay, we've got these other systems that says, the investor sentiment is very complacent, very bullish, overly bullish, by historical quantification. Secondly, is that you have oscillators that track momentum when they get to extreme levels. That's a good thing, right? When a price is going up and it's going up extremely fast and high in magnitude, hey, that's a good thing. But that also can be a contrary indicator that there's might be more risk that it could reverse or at least stall. And and then the third thing would be breadth. How many if you got 5,000 stocks trading on New York Stock Exchange and 70% of them are rising in price, by some definition, it tells you, hey, you might be a little late to the party. Back when it was at 20% and rising, that's a good thing. When you get to a certain point, there's only so much demand out there, and then any little slight thing can cause the prices to reverse. And so, while we are mainly focusing on trend following, at the same time there are some occasions in time where things can, where the probability is that it might actually either stall or reverse. It doesn't. Hey, if I said it was 80% chance that it would, people hear that, they think that means it's probably going to happen, and they take that as certainty, but it's not. See, it's still not certain, because it means that there's 20% chance it won't. But sometimes we may sit back and we notice these things, and what we're really doing, I guess sort of somewhat of an intuitive side, is we pay attention to what other people are doing, and we know that by sentiment, and we know that by how bullish they may be speaking on TV or whatever. I mean,
you're quantifying this though. These are not gut feels from Mike Schell.
Yeah, no gut feels. I mean, I'll say the gut feel would be that, hey, when you see whenever you see all these various indicators, hitting certain levels, then you kind of you start to know that. You see, that's the funny thing, Mike, is the paradox in a lot of things is that the paradox is, in the best way you could really select an investment manager would be to say, okay, they have got a completely quantitative, systematic process that is repeatable, and they repeat it, and they have the discipline to repeat it, and they've been doing it for at least 5 years or more. And if they're doing it quantitatively, then that, especially if it's based on price, because anything that you do that is different from price, okay, like the P/E ratio or something, has the potential to go way away from the price trend itself. So if you're focusing on what the price trend is doing, you're doing it systematically. You've got some indicator that tells you when to buy and when to sell, and you have some system that tells you how much to buy and sell, and then you do it repeatedly and it's systematic. Then that is the only way. That is an objective system, and it's the only way that you can really know if there is really any odds that a system will be good. Because if you're dealing with somebody who's just sitting around trying to figure out what's going to happen next, you don't know how they're going to feel in the morning when they wake up. You see.
Let me. I've got a great line that I pulled from your site that I think people will enjoy, and I'll let you expand upon it. And I'll just read this out. It says, but I can tell you, I don't worry about things that haven't happened. A wise man once told me that people spend much of their lives worrying about things they don't ever occur. Because they worry, they experience those things over and over, even though it never happened. That is, you experience the things you fear the most over and over again by worrying about it. Instead, I suggest you know what you'll do if it does, but don't wait around looking for it. For me, I'll just rotate out of things that are falling into something that isn't. It's what I do. Predefine your risk by knowing at what exact point you'll exit if it's moving against you. Then, don't worry, be happy. Now that's a loaded statement. I mean, if anybody ever said, "What's Mike Schell's secret sauce? What are all these great trend following traders' secret sauce?" Well, there it is, right there. Now, someone might say to me, they might say, "Well, Coveil, that's some general baloney, whatever. That's not specific." And I would argue that is very specific. That is the heart of the matter.
Yeah, Mike, it's funny. That's the genius in you, and why you've written such great books and all the things you've done is that you pick up on those things, and you know exactly what I mean by that. And other, a lot of other people don't know that, and I can tell you that you're right. I mean, that is the something about I think we all want to have, again, going back to being able to know a good manager would be some very systematic process, but at the end of the day there are some human elements to it, some individual traits, and that is the ability to embrace certainty, and like you just said, you just threw in another key word, is the worry side of it, is not setting, people. What that means is that people they sit around and they worry and they ruminate about what might happen, and they try to sometimes they go through scenarios and things. What I do and what the few good investment managers that I know do is we predefine these things. I mean, I know right now. My TV is off. I don't never watch the financial news, and because I tell you, it makes me nervous. It does. It makes me, within a matter of minutes, I'm just real nervous when I watch it. And I think that
hold on. Why do you get nervous when you watch it?
Well, because I think that it's just that fast paced. It's very exciting. And that's not what I'm doing this for. I got other things I do for excitement. So, it's I think that it's a very it's really.
I think a lot of people are like. I mean, I'm like that. I mean, we're all like that. You turn it on, and they're all going crazy, and you start to feel like there's something exciting going on that you're missing out on, and then you turn it off, and you're like, okay, I forget about it now.
Well, that's a good point. Is what you're missing out on, because they'll show Apple, is gone up in 10%. You're not in Apple. I mean, that's kind of what that's precisely. It's a lot of psychology and how it messes with you. And I think that what people do is they people worry about things that haven't. People tend to worry about things that haven't happened. And if you worry about that, if you've got something that you worry about so much, and you're so afraid of it, and it hasn't even happened yet. If you do that enough, and I kind of think about, the hot girl that, I dated back in school or something, I think it was an analogy somebody told me one time or mentioned, I guess, or in the conversation, is that, hey, you thought she was a flight risk. And so, you're always worried she's going to take off. And when you're 15, 16 years old, that's just what you do. You're afraid she's going to run off and leave you. And hey, when you experience that, with that worry over and over again, then she might as well be doing it, because you treat her probably like she did. And so I think that's what I mean by that. And I think that if you predetermine what you're going to do, and you already know what you're going to do, I can tell you right now, I determined about 10 years ago what I'm going to do right now. I determined 10 years ago what I'm going to do next. And all I'm doing in the meantime is I'm sitting around and keeping my own self in the right condition and mental state to be able to pull the trigger when the time comes. That's what I do, and that's what I think that in the meantime, though, hey, I know a lot of other people that are trying to do things. They're trying to manage money too, and that's the biggest thing that I notice between me and them, is that I am very confident in what I'm doing, and some people may even think there's some ego involved in that, but it's not. It's any ego that I have is maybe in the confidence of what I'm doing, because I've been doing it long enough to be really feel really strong about what I do, and has nothing though to do about me. It's not about I have some crystal ball or whatever. It's just that I've got a system that I think that it's got a strong expectation to work, and based on history and based on what it's done. So I think that Most people, though, like I said, they're sitting around trying to figure out what's going to happen next, and and they're worrying about it. And as soon as the market goes down and they start losing money, they're afraid of losing more, and eventually usually by the time they decide to do anything about it, they wait till it's too late, and then they're out of the market, and then the market's taken off and goes up 50%, and then all of a sudden they're fearing missing out, and the more they fear missing out, the more stress and pressure they have to jump in, and that's kind of a lot of it is psychological. But let me say this, though. One thing that I'm amazed by is that you see a lot that people say, oh, we're going to do some kind of mechanical type system and it takes the emotion out. Well, that is far from the truth. I mean, listen, hey, if having a quantitative rules-based system takes the emotion out, why do you think that people like Charles Faulkner or Ed Secoda or Van Tharp or any of the others are do what they do? They the funny thing about it is that when you've got a quantitative system, then you spend most of your time focusing on what might I do that might make this go wrong. That's the only thing, and that's not worry, by the way. That's just sitting around, noticing how could this go wrong. And it's kind of like an engineer. I was telling somebody recently. Once you developed a good program, or say a good car, I'm a big BMW fan and Porsche fan. Those are high quality cars, and they're quality because they go out there and they got great engineers. They try to break them. If you develop something good, then what you want to do with your time then is going forward is to try to break it. Really, try to figure out what might be wrong with it. What part of it may be wrong.
I'm thinking about that braking thing, and you brought up the Porsche. I know a couple of years ago there was I think there was an accident out on PCH in Malibu, and some guy that had a wild hair, he had his $250,000 Ferrari, and he decided to do something stupid, and he survived, and basically the car melted down, and he was sitting in his little cage, the only thing that was left after the Ferrari melted down in the accident. But they had spent a lot of that $250,000. So when the car got destroyed, you'd still be alive, and that's what you were paying for.
Yeah. That's exactly right. I mean, I think that the funny thing about it is at the core of all we do, and I think that if you go back and read the Market Wizard books and read your books and all these things, I think the commonality that you tend to see is that at the core of all we do, and this even Warren Buffett is all about, well, Warren Buffett does a little differently, but it's all about managing and controlling your risk. And that's how when you have here's the paradox again, many paradoxes. It's almost like everything. What I've learned is that almost everything that I believe has some paradox of an opposite belief that seems to contradict it, but it really doesn't. And it just seems that way. We perceive it that way. One of them is that in order for me to develop a really good risk management system, I had to, at some point down the line, believe in my mind and truly believe that I don't know the future and that I have no control over the future, or even the probability of the outcome of trades. In other words, that it's just as random as it can be, and I can't do anything that might increase the probability of a position being a profit. You have to really believe that, truly believe that, in order because if you don't believe that and you think that you can pick things and control it by your picking, I believe the exit determines the outcome, not the entry. It's not where you buy it at. You can't make it go up. Okay, but in order to create good risk management systems, you've got to really truly believe that. And I don't think many people can't get to that point. They can't get to the point where they truly believe that deep down. And that's what it takes to develop good risk management systems, because if there's any part of you that believes that you do have control over the universe and that you can create your outcome based on what you're buying, then you don't ever get to the point where you can have a good risk management system. And where that ties into what we're talking about, Mike, is that when you have truly got a good risk management system, that is when you do let it go. That is when you embrace the uncertainty and you sit back and watch it unfold. That is when you don't sit around and worry about what's going to happen next. I mean, we went through the terrible conditions the last 5 years, very well. I'm very proud of what we've done. I mean, I did it very intentionally. I wrote about it years before it even happened, that we were going to be prepared for whatever might happen, and it's all very intentional. But the intentional doesn't mean that I had a crystal ball, though. You see, I was just prepared because I knew what might happen. And you got this big range of things that may happen, and you've got to have some way of adapting and responding to those things. But if you most people, and I think this is something I've noticed that you stress a lot, because you've really heard this from more than just me, is that most people, they can't get past that entry side to things and be able to get to the point where they're able to really have a good risk management system. And that risk management system is what allows you to let it go. And as Ed Sakota says, go with the flow. And I say be a flow master. I've made that comment a few times. And that just, is just sitting back and just letting it unfold, because we know in advance what we're going to do.
Let me interject this, Mike. I want to. You've given some great time for us today, and I know I can't keep you all morning, but I'm looking at a couple different things, and they tie together in my head. And I guess and I'm going to lay this question out. The issue that I often hear from people is, well, if everyone becomes like Mike Schell, that trend following will cease to work. But I think there's some larger issues here as to why what you do, your systems, and why there is some success. And there's a couple different things I'm looking at here. One would, and I noticed you're fond of the Shiller line, that this argument for the efficient markets hypothesis represents one of the most remarkable errors in the history of economic thought. I thought that was a great line. And I think further talking about, market anomalies, these price and or return distortions on a financial market that are contradict the efficient market hypothesis. But I think, and you brought this phrase up too earlier, which is one of the phrases in your blog, is the notion that market returns are asymmetric. They have fat tails. They make it's an asymmetric distribution. It's not a symmetrical normal distribution. And I think that's a little bit heavy lifting, all those thoughts in there, not for you, but I think trying to explain that to people that we don't have efficient markets. We have these fat tails, these outliers. I think maybe if you could speak to that and maybe try and give people are out there that are listening, and maybe give them some confidence. And I guess for some people it won't be confidence, but I don't think human nature allows anywhere near a majority of people to ever accept the ideas that I just brought up.
Yeah, that's an excellent. I'm glad you brought that up, because that's one of my favorite topics, and maybe one day I'll write a book on this topic. I think first of all, you mentioned that what if everybody becomes like me? Well, I'm not the only one doing this stuff, but not everybody's good at it. But I think that the thing is that, rest assured, of all the conversations that I've had in the last several years, there are very few, and this would be whether it be with other money managers or just or maybe prospective investors or whatever. The majority of people that we talk to, they don't quite. I'll say that I think most investment managers have a hard time getting it. I think a lot of